So in looking at, what's going to happen next and how will this work next time, I really don't believe that at this minute there's one lender out there that really has a clear formula in their mind on how the next building will be financed. I think today, if a building were to be financed today, you would probably see a condo maybe in New York City where it'd be enormous amount of cash, enormous amount of financial statements behind it, because right now, the banks have to, the one thing that the banks have to do today that is different is that they have to look at the developer having the ability to carry the property and how is there a secondary takeout at the end of the day. They have to be able to address how do we get our money paid back if the first system doesn't work. And the developer has to have the financial wherewithal, or the owner, to be able to carry that project free and clear cash flow. And they have to have a clean balance sheet, meaning that if they're on lots of different notes coming in the future, or on existing notes, that's going to be an issue. So if you are going to structure a deal, the way I see it go is first you're going to have to address the issues of the law. Is that me?
Yeah.
I thought I said it all.
Another deal coming.
That's another deal, Andy.
How the law shakes out and what kind of rules they can get permitted or changes to strengthen the weaknesses of the deal is because what's going to happen is as the lenders are dealing with the problems that the law has created in their litigations, that's going to have to be addressed. There'll have to be some changes in people being able to walk on their deals for adverse and material type thing where a judge can make that change. You're going to have a clearer understanding of escrow deposits, who, what, where, and when. So a lot of these legal things will have to shake out. Secondarily, you're going to have some kind of way to be able to have control of the cost or mitigate the fact that particularly, I'm going to separate out high-rises and low-rises. I'm more likely right now talking about sort of high-rise type projects. The thing with a high-rise is that it's got such a long period of time, and we all know that the cost, they could have a bonded contract, doesn't mean anything down the road if the costs go up. It just means that they have to pay for it to get the building built. So I think that there's going to be something that's going to have to come up to mitigate the risk of costs on these high-rises. That how do you mitigate the risk? And it's not going to be so simple. It can be simple, put up a 40% letter of credit, but there'll be mitigation on that in some fashion. There'll also be mitigation in terms of the kind of appraisal that I think they're going to be looking for on the property. I think that they are going to be really starting to look at what is the downside of the property, what is the rental value, the economic value if the property had to be liquidated, and all these things are going to go into the pot. But if somebody came to me and said, give me an idea of the model that we have a market, and more importantly, obviously, you have to have a very strong market demand. If somebody came to me, I would say that it would have to probably look something like this. It would probably be, if the cost was $100 million, you would probably have to have probably $40 million in cash in the deal today.